There we go. Good morning, Neil, Vinny. How are you today, guys? You both well?
All very well, thank you.
Good
Yes, thank you.
stuff.
Yeah.
Nice to be
Good.
here.
It is very pleased to have you both with us today. Really looking forward to today's session, gents. I really am. I think it's a hot topic, a talking point that many people are facing at the moment. So I'm very interested and excited for today's session. I really am. As always, I'm just going to give it sort of 15, 20 seconds before we kick things off. I just want to make sure it gives everybody time to get themselves in, get themselves sorted. Um, as always, we do plan for our session to run for the full hour today. We do like to keep things as interactive as possible. So if at any time anybody's got any questions, please do not hesitate to use two of the functions available. You've got the chat function where I think somebody has just said hello, and we've got some note takers in the room, which is absolutely fine. If you want to ask an open question to the speakers and the audience, you can do so there. If you'd like to be a little bit more anonymous with your question, there is a Q&A function as well. So please ask us questions wherever you feel comfortable. As always, our sessions are CPD accredited. So if you do require CPD after today's session, when you exit the webinar today, a feedback form will pop up. On that feedback, we'd love to hear your thoughts on today's session. It takes about 2 minutes to complete. At the bottom of the feedback form, there will be a section where it will ask you if you require CPD from today's session. So please do come along, give us some feedback, get your CPD from today's session. Going to kick it off because I know the guys have got plenty to talk about today. Just briefly touching on who we are at the Financial Planning Club. Amanda's background is running two very successful financial planning businesses, one employed, one self-employed, national advice businesses. Myself and Lewis have a background in recruitment. For the last 10 years, we've been supporting firms with structure, scale, and culture within their organizations. Jade is the glue to our business. We would drop near enough everything if it wasn't for Jade providing incredible support. I've shared my LinkedIn there for you as well. If you'd like to connect with me, I do create short video snippets from today's webinar and all of our other webinars, and also a regular newsletter really talking about the industry as well. So please do give us a little connection and stay in touch and up to date with what is going on in the club. But look, we couldn't do what we do without the incredible support and the incredible backing of every single one of our collaborators, joined today by LV. Great content delivered by some really awesome firms and some great people. So a big shout out and a thank you to everybody that is collaborating with the club. As many of you know, as many of you are very much a part of, the club does like to build a community for everybody. So we've got our WhatsApp communities, depending on the role that you play within your organization, whether you're a business owner, a power planner, solely a financial advisor, ops manager, whatever it may be, we have separate communities on WhatsApp to provide that support from others that are physically doing the same job role as yourself. So if you want to network and mingle with others that are playing a very similar role to yourself, then do let us know. Again, in the feedback form is where you can request to join one of our WhatsApp groups. One thing I'd say, mute it, because the Power Planner group, there's over 500 Power Planners within that group. So when there's some questions and Q&A thrown around, it does get very busy, but it's a very good place if you're ever stuck on something. Particular challenge, you will get responses, you will get some support. So please do head over to the communities. Club Lives run weekly, expert-led. Got Neil and Vinny with us today from LV, practical and CPD accredited. And the Financial Planning podcast is where you can hear from owner managers of financial planning firms, the highs, the lows, the good, the bads, the uglies, and everything in between, and what it takes to run a financial planning firm, regardless of size, whether that's a one-man band or a multi-advisor firm. We have had some awesome speakers on the podcast. So again, you might have a story that you'd like to share about your journey on running a business. Do let us know and we can get you on the podcast, which I believe is released weekly. And you can find those on your Spotify's and your Amazons and wherever you do tend to listen to your podcasts. Just want to give you a quick high-level overview of what we've got coming up on Friday this week. We're joined by Aspen We're going to explore whether traditional risk profiles are still fit for modern financial planning and how firms are increasingly focused on client outcomes rather than risk scores alone. Then next week, we are with Tatton. Tatton will be helping us make sense of today's economic environment, looking at what the so-called New World Disorder means for investors and portfolios. Again, another very good webinar. And then on the 10th of July, we're back with our friends over at Bear Rock to really look at consumer duty aligned client satisfaction surveys, put your teeth in, Lee, and how firms can evidence good client outcomes more effectively. Again, all CPD accredited. So same way that you sign up for today's webinar, head back over to our webinar page on the Financial Planning Club. And not only can you revisit any of our webinars, but you can sign up to some of our upcoming webinars as well. Today, as I've said, we've got LV in the room today. Firstly, I'm just going to introduce the guys. We've got Vinny with us, been with LV since 2012, spent the last several years supporting advisors as a business development manager, helping firms deliver great outcomes for their clients. Also joining us is Neil. Neil, you've been working with financial advisors since the 1980s, brings a wealth of experience across savings, retirement and tax efficient planning, supported advisors across London and the South East. Hopefully, guys, the bios are correct and I've introduced the right people. That always helps. And lastly, look, we always ask the audience when they register to our webinars what kind of concerns they have and what really they're looking to get from today's session. So always got a good mix of owner managers in the room, some team leaders, IFAs and planners and everyone in between. So we've always got a real good mixed audience in the room. The biggest area of interest is around the practical tax planning opportunities, particularly the role of bonds and trusts in today's changing tax environment. It's a hot topic. I know it is. That's why we're here. That's why we're covering it. And overall, firms are looking for solutions that balance tax efficiency, client outcomes, along with long-term wealth preservation. Guys, thank you very much for joining us. I know it's going to be very, very good. And we do have some of the team behind running the slides today as well. So I'm going to stop sharing my screen because I know we're going to kick off the webinar right away with a poll as well. We're just going to have a little bit of an ask the audience to kick things off. And that is, what do you think was the top concern of consumers about retirement? Because I think, you've also run this internally, guys, is that right?
Yeah, we have. We ran a webinar to a group of over 300 advisors about 2 weeks ago. And we've also been talking about similar topics to other advisory groups as well, which has been very, very well received. And it's very much a topic that is at the top of everybody's agenda at the moment.
Yeah, it is. It is. Would you say, a playing factor is different age groups approaching retirement tend to have different outcomes as well, would you say?
Yeah, definitely. I think it is down to, the individual that you're speaking to at the time. People don't retire in the way that they did with my granddad did, who walked down the road at 65 to greet him. There's a lot of, retirement seems to stretch on. And people sort of retire in a much more slower, more controlled way probably than they did do in the past. People want to spend their retirement in a much more different way than they ever did in the past. So that takes cash. And, with that, as we go on to the presentation, we've seen an awful lot of tax changes over the last 4 years, and they will continue to happen, I've no doubt.
Yeah. And do you think that, people are having sort of retirement concerns? Are they changing over the last sort of 5-10 years, would you say?
Yeah, definitely. And I think they've been changing significantly over the last 18 months.
Yeah.
I think pensions were being used in a particular way for generation planning, as well as taking income in certain circumstances. And that was quite a comfortable way of doing things for a few years.
Until
we've got to go and talk to our clients about maybe addressing some of that planning. And this presentation, I hope, will support your colleagues.
Yeah, absolutely. Thank you for everybody that participated in that poll. I'm going to share the results on screen, and I'm not surprised. Are you guys around running out of money? Being a big client concern. I've had it with my own parents recently. That is their fear of running out of money in retirement. Are you finding that? Was that a common theme in the last poll that you run as well with the 300 advisors?
Yeah, I think it's with both. It's interesting because what I will talk about during the presentation is something that we do at LV and have done since 2020, which is our health and well-being report, and that will bring out what the result is of this or what the answer is to this. Because surprisingly, running out of money is very, very important, but there's another concern for people in retirement as well, and then that creates a situation where people looking at planning as they're approaching and entering a deaccumulation phase, and needing to have flexibility and adaptability in their planning, as well as looking at making sure they have money.
Yeah.
And it's that longevity as well, isn't it? That we're sort of seeing more and more and more people living longer. So that's another big factor that we're sort of seeing that we need to potentially bake into the mix when we're looking at a retirement plan or a retirement proposition.
Yeah, absolutely.
An interesting concept that came out recently, or a comment from the head of policy at Aegon, who was talking about the fact that we're shifting into 2 50-year plans for our clients. So
Okay.
those people that are that 0 to 50 and then 50 to 100, because the vast majority of 50-year-olds today are more than likely to live to 100 years old. So we've always been planning. When I started in this industry, you were planning for probably 20 years.
Yeah.
People retiring at 65, and they were looking to go. They 15-year planning, but now it's having to have a plan in place that might need to last for a hell of a lot longer.
Yeah, it's probably why people are not retiring as early as they should do, right? They're just hanging on for as long as they can. As long as my knees hold up, I'll keep going. I know we gave 3 options there on long-term care costs, running out of money, and everyday living costs. But look, if anybody wants to add to that, pop it in the chat function as well. It'll be interesting to see what other concerns that your clients are really thinking about when it comes to retirement planning as well. I'm going to stop sharing the results, and guys, over to you.
Thank you very much. I've still got the poll sitting in front of me. Does it have to move?
Yeah, I've stopped sharing. So just close your one down. I've stopped sharing it for the audience, so you might just have to close it down on your side.
Yeah, I haven't taught me the technology yet. But anyway, good morning, everybody. My name's Neil. I'm the Business Development Manager covering the Southeast for LV. I'm the older looking chap in the photographs. And first of the things I think it's worth talking about this morning is the key CGT and IHT changes we've seen, particularly from 2024 and moving into next year, into 2027. And what do these sort of changes mean for us all working in our profession? Because it's effective for us as well. And the fact is that pensions can no longer be treated as being outside of the estate. We need to reframe that legacy and drawdown planning ahead of 2027. We really need to be having those conversations now. More clients are going to be pulled into tax due to the frozen IHT thresholds, lower CGT allowances, and those higher CGT rates. And I think more than ever, I think estate planning conversations need to start earlier, especially around sort of 2 particular concepts, and that is spend versus preserve, and gifting and beneficiary strategies. Something that we can really add value to our clients from an advisory point of view. On top of that, and something that I think has sort of been missed along the way, is the fact that the executor complexity increases. Clients need clearer nominations, records, and a lot more joined up advice across pensions, wills, and trusts. And I think a lot of what we'll be talking about during the next sort of the next 20 minutes, 25 minutes, will be about, it's not looking at one particular tax wrapper, it's looking at a multi-tax wrapper strategy. So I've already mentioned our Wealth and Wellbeing report. We mentioned it earlier, and we've published this fantastic piece of consumer research since around 2020, and we've been able to do that because as a mutual, obviously our policyholders are owners of the business. They have effectively the shareholders of the with profit. So we're able to go out to them on a regular basis and ask them what their key concerns are at a particular point in time. So the pension changes have triggered an advice demand. So 1 in 4 adults plan to seek to help to maximise their pensions following the budget in 2024. And you'll be having those conversations on a day-to-day basis. You know, retirement fears are running deep. Consumers' biggest concerns were, to answer the poll, long-term care costs, ironically, very, very close behind running out of money, covering everyday living costs. And I think that it's the bit that Vinny mentioned earlier on as well, is the fact that we are living longer, and it goes back to this 50-year plan, is that, quite right, running out of money is really, really important. But actually there's that additional concern of health and will they need long-term care? And how is that going to be funded going forward? Also, the inheritance tax anxiety is rising. People are more worried about IHT. You know, 12 million adults, when we look at 22%, 21% have already looked at what their likely IHT bill is going to be. And when we talk about tax wrappers, I think it's true to say that investment bonds, which I'm going to focus on a little bit this morning, have been almost a bit like the forgotten tax wrapper. I've sort of got out of use for a long period of time of using them, what I would consider in anger. You know, when I started in the industry, there was an awful lot of investment bonds written, and they sort of went a little bit out of favour. I keep going back to that, and but we did write a lot of investment bonds at that stage. And they are the most versatile tax wrapper there is, but working and running them alongside the other tax wrappers makes a fantastically flexible planning situation for your clients. And it's invaluable for you as advisors to be looking at these in more detail. But the intent to pass on wealth is strong. But I think we know, and we're gauging it from our clients, confidence is low. You know, people still want to leave wealth to their kids. I want to leave wealth to my kids, but there's that bit of how we pass that on to our children in the most tax efficient way, but also making sure we don't leave ourselves vulnerable with regards to income and long-term care costs. But where does the FCA, what have they got to say on inheritance tax planning? You know, it's been interesting that I think that they've really started to have a bit of a laser focus on particular areas, the FCA having sort of not taken their eye off the ball, but been focused in other areas since probably pension freedoms running way up to the pandemic. But now they're sort of really looking at specific areas. And what they're talking with regards to inheritance tax is fair value must consider outcomes, not just tax efficiency. So in its consumer duty work, the FCA stressed that fair value assessments must be both holistic, taking into account product design, ongoing support and consumer understanding. So why does this matter in estate planning? Well, bonds and trusts are often justified just for IHT mitigation or the 5% tax deferred income and control and phasing of wealth. But so the FCA position really implies that tax efficiency element alone is not enough. Firms must show how the product meets the client's objectives, supports them over time and delivers value relative to the complexity and cost. So why are bonds back? First, the CGT changes. Following the autumn budget in 2024, we've seen the annual CGT allowance slashed and rates rise. That's made tax deferred wrappers like onshore bonds more appealing, particularly to clients sitting on unrealised gains and those that want to avoid an immediate tax charge. From 2027, as I've already alluded to, and we all know, it's been well versed in the press, unused pension funds may become subject to IHT. That's a major shift that could catch many clients unaware. Bonds can help diversify that planning conversation, especially where pensions are no longer the IHT shelter that our clients thought they once were. Loan trusts and discounted gift trusts, when combined with bonds, are becoming increasingly attractive. And they offer this balance of control, access, and IHT mitigation, running alongside the income and pensions that we get from pensions. The bonds offer tax-deferred growth and all that important 5% withdrawal facility, allowing clients to access income without necessarily triggering an immediate tax charge. And this is particularly helpful for higher rate taxpayers and those looking to manage their income levels. And the more that we can use tax wrappers in that way, the more efficient we can make that later life accumulation, deaccumulation planning. They offer sort of clarity in a landscape where pensions and allowances are constantly shifting. Bonds stand out for their certainty and simplicity, and I always have to touch wood when I say this, but in those number of years that I've been working in the industry, they seem to have been forgotten by everybody, investment bonds, and so haven't really been touched from a legislative point of view. And I think that's an important way. So the tax treatment really is on bonds is well understood. And I think they do definitely provide peace of mind both to advisors and clients. And we at LV have certainly seen a significant growth in this tax wrapper, again, over the last sort of 24 months. And finally, the legacy planning angle. Onshore bonds placed in trust can play a really, really effective role in IHT mitigation, while still allowing access for the next generation. So that's really, a really important contrast, which brings me on to a really important thought that I'll leave with you, and it's quite thought-provoking when I've delivered these presentations, and that's that around 70% of women change their financial advisor after the death of a partner. That's normally within the first 12 months. Let me think about that. That's 70% of women change financial advisors. So if you've got 10 million under management, that's £7 million at risk if something happens. The alternative is that also that's an opportunity, because there are people looking for advice that haven't necessarily got a relationship with the advisor that maybe their partner had. So it's a good opportunity to go out and visit those clients. And it's a powerful reminder that intergenerational and estate planning isn't just a financial need, it's a relationship opportunity. And using tools like investment bonds offer a way of really building that trust and staying relevant across the generations. So are onshore bonds good for certain people? Now, whenever I talk about investment bonds with my advisors that I've been working with for a number of years, of course, we all know that investment bonds are great for individuals and trustees. But a little known fact, and an area that I do quite a lot of business is with corporate investors. And that opens up a whole new swathe of conversations that you can have with your professional connections. So onshore bonds are treated as having paid 20% tax on any gains. In reality, that tax deducted within the fund is likely to be less than this, and we're doing some work on those particular figures. No tax is payable on dividends received, but certain gains after indexation are taxed within the company at 20%. So the deemed 20% paid within the bond is available as a tax credit to offset against the company's other liabilities. And how the investment bond is assessed for tax within the company depends on whether it's classed as a micro entity or not. And it's a presentation in itself discussing about bonds with corporate investors. So if you do want to have a discussion about that, speak to Lee, and he can put you in touch with us to have further discussions on that, or you might have a relationship with a local LVBDM anyway. The thing is that more successful businesses, private companies, often have surplus cash on deposit. It's not needed for working capital or set aside for a specific purpose. And many long-term deposit accounts penalise for early access. So the bond allows access at any point, and so can be used as a much more effective tool, although they should only be considered for medium to longer term investment. But again, it opens up a whole new client feeling, client opportunity. So I'm just going to talk about an introduction to loan trusts, and hope it's not teaching granny to suck eggs here, but loan trusts they've been around for a long time, but equally I'm having discussions because we've forgotten how to use them, and we've forgotten what they do, and we've forgotten how effective they are. But a loan trust is an estate planning arrangement where the client lends money to a trust or trustees rather than gifting it. The trustees then repay the interest-free loan, which can also be repayable on demand, meaning that the client has access to the original capital at any time. And it brings us back to this fact that clients are worried about an income, they want to do generation planning, they want to gift, but they're nervous about having access to their existing capital. The trustees can then invest that loan money, an investment bond, and which is held in trust, and they will repay the loan via the 5% tax deferred. So in its simplest way, let's have a look how the trust works. So the settlor, person setting up, sets up the trust with a gift or a promise to make a loan. The settlor makes an interest-free loan to the trustees and has access to the outstanding loan at any time. The trustees invest in a bond for the purposes of repaying the loan, 5% withdrawals, 4% withdrawals, 3%, depending on how long they want that loan repayment to last. And plus they're achieving investment growth. Any investment growth is held for the benefit of the trust beneficiaries and is outside the settlor's estate from day one. And however, any outstanding loan is included in the settlor's estate for IHT purposes. So the idea is, take the money and you spend it, you repay the loan, or potentially gift it out. But I'll talk about that in a second. One thing I will say here is a little bit of that. If you do set up a loan trust, is making sure there's part of the will that makes it clear that on death it doesn't need to be repayable. It won't leave the estate, but it doesn't demand that that loan is repayable, and then that can be used to be passed on. Staying there growing and be passed on to the beneficiaries. So, the benefits of a loan trust. What we have seen is an increase in use in discounted gift trusts. And whilst we at LV don't offer them, they continue to be a huge go-to tax wrapper for many advisors. It's changing more and more, and advisors that I'm talking to are looking at the advantages either of a loan trust or a combination of trust planning, so a DGT and running a loan trust, because they both complement each other extremely well, but work in slightly different ways. Loan trusts are particularly attractive because, as I've already said, clients in the main are happy to give away the growth, but want to keep access to the initial investment. With a DGT, that can be a chargeable lifetime transfer or a PET, with less than the investment. There's no initial IHT charge on the chargeable lifetime transfer if the nil rate band is exceeded. And with a discounted gift, that falls outside of the estate after 7 years and provides a tax-efficient income to the settlor. But in theory, you shouldn't have to be able to break a DGT because of the gift with reservation rules. That sometimes unsettles clients. So there could be an element where they're happy to gift money on day one, and they could use a DGT, but use a loan trust alongside it, or alternatively, use a loan trust in its own way. So what more and more advisors are realising is that many clients are wanting to cap the IHT liability, but they're cautious. And whilst they don't want to give up access to the capital, they're happy to let the growth go. Loan trusts are perfect for those people with large estates, but want to get growth on a lot of money outside of the estate from day one. So we can take an example of a client with 1 million, but they can only do a 325,000 gift trust. So they instead will do a 675 £200,000 loan trust, no chargeable lifetime transfer, and a 325 gift trust, which gets the growth on the 1 million out of the estate. So using, therefore, a combination of trust planning. Let's put this as a quick example. We're going to look at a couple of case studies. So in this one, James sets up a trust and makes an interest-free loan to the trustees of £200,000. Trustees invest in a bond that returns 5% a year after all the charges, and he will ask for a loan repayment of £7,000 at the end of each year, which he will use to supplement his retirement income. He'll also write off a further £3,000 using his inheritance tax gift exemption each year. After 20 years, the loan will be fully repaid. Hopefully, settlor has spent that 5%, that loan repayment. And the bond is worth just shy of £300,000, all outside of the estate. So that value is now outside of James's estate and is not assessable for inheritance tax. If James died while some of the loan was outstanding, the outstanding loan would remain in his estate and be assessable for IHT. Any investment growth would be outside of the estate for IHT from day one. So a really, really flexible, versatile way of planning. And once it's explained to clients, they have quite a lot of peace of mind. But let's take an example of Florence. She created a loan trust and invested in a bond at age 50. After 10 years, reached the age of 60, she requests a repayment of £500,000 from the trust. She's been deferring that repayment up until that 10-year point. At that point, the cumulative 5% tax-deferred withdrawal allowance is £750,000. So the £500,000 falls within that tax-deferred allowance, so does not cause a chargeable event. Any future growth on that £500,000 repaid will now be outside the estate, and any future investment growth on that 500,000 repaid will now be inside of the estate because they've taken that money back in and be accessible for IHT. However, the value of the bond and then the future investment growth on the rest of the money is outside of the estate, although that will be reduced from around 2.165 million over 20 years. So let's move that on another 5 years to her 65th birthday. She then decides she wants to gift a further £300,000 of the loan. So at this stage, after 15 years, the cumulative 5% tax deferred allowance is now 1.125 million. So after accounting for the £500,000 she got when she was 60, there is 625,000 in deferred withdrawal allowance still remaining. So that £300,000 will therefore not cause a chargeable event. She can use up to £6,000 of that gift would fall within the annual exemption for IHT purposes using the allowance carry forward. So the remaining 294 would be a PET or CLT on the gift that she's passing out, depending on the loan trust used. If a CLT, this would fall within the £325,000 nil rate band, meaning no immediate tax charge. But the point is that by using a combination of trusts in their simplest form, we can do some really, really effective planning. And I think you can see from an income perspective and a longevity expectation and making sure that we're providing an income for a long period of time. Using a combination of trusts or using a loan trust, you're providing that client with IHT planning and access to income, which are two of the biggest issues that came out of the health and wellbeing report. I'm now going to hand over to my colleague Vinny, worked alongside each other for the last 6-7 years, who's going to talk you through our smooth bond in particular.
Thank you, Neil. I hope you can all hear me. Neil, I always like listening to your session. Some great ideas. What one I always pick up on is that blending of trusts as well with the DGT and the loan trust to give you that sort of, fixed income, and then also your discretion or your flexibility from the loan trust. And also that chargeable lifetime transfer point, that's often one thing that advisors I speak to are really interested in, and obviously helps with more chunkier funds that you're looking to put into the trust, and the order of gifting and how that all can work together. But yes, for those who don't know me, my name is Vincenzo Lamonico. I'm a BDM here at LV. People tend to call me Vinny, keeps it nice and simple. I work in the Herts, Beds and Bucks area. And for the next 20 minutes, I'm just going to sort of take you through how to set up a loan trust with LV and the forms that we have, and then also looking at uh, the smooth bond, or what we call, or our onshore bond that we use within the loan trust. So just to sort of revisit how to set a loan trust up that Neil went through. So the settler would set up a trust with a gift of £10. That's just an asset within the trust to get the trust going. The settler enters into a loan agreement with the trustees, and then the settler makes an interest-free loan of the bond in this case to the trustees, and then the trustees are responsible to pay that original loan back to the settler. So as Neil said previously, inside the estate is the original capital, and outside the estate is the growth, and that is from day one. Also, another interesting point that Neil talked through is making use of your gift allowances each year as well to chip away at that original capital. So, as an example, a single settler using their £3,000 gift allowance to write off £3,000 of the loan each year. Another useful tool for IHT mitigation of that original loan. So when setting up a loan trust, I thought I'd sort of point out, how we can help at LV. So we have two loan trusts. What that is we've got a fixed loan trust. So if you just want a single beneficiary, then we've got a fixed trust deed that you can use. Or if you want discretion on your beneficiaries, then we've got a flexible trust deed, a flexible loan trust deed that you can use. In the bottom right-hand corner of the slide, you'll see there's two sort of images of the of a Q&A document, sorry, for the fixed and flexible loan trust. And within those documents, they're fantastic. They give you lots of answers to questions about who can be trustees, how tax treatment of a loan trust, etc. But then also there's a useful guide about how to fill out the forms, which we will touch upon in this in this presentation as well. But Lee, I think you'll get a copy of the slides out, and when you do get a copy of the slides, if you just click those images, it sort of hyperlinks you through to those documents to make it nice and easy. Also, the BDM support from LV. So people like Neil and myself, we're hopefully you'll get to experience it, but we're up to speed with how to set up a loan trust and what's needed within the form, so we can help you out with that. Our team who actually sets up the bonds and processes and sets up the trust as well, the team that sort of sits behind us in Hitchin, they're fantastic, very knowledgeable, and also our technical team. So yeah, if there's answers to questions that are needed that Neil and I can't answer, our technical team is brilliant. Many years of experience within that team, and there's not anything they've been able to not help me out with so far. So yeah, on to the next slide. Sorry, Denise. So the forms that we have. So we've got our flexible loan trust deed or fixed, depending on which way you go. So within that form, we're setting up the trust. We name our trust, and we set out who the trustees are going to be. On a loan trust, if both settlers, so say husband and wife, want to make a loan to the trust, if they're both going to be trustees, we would strongly recommend having a trustee that's not a settler added alongside it. So not saying you have to have three, we advise that you at least have two, But if both settlers are going to be trustees at outset, we recommend having a third who's not, purely because if an unfortunate thing happened, both died in a car crash, then at least there's another trustee outside of those two who can help carry out the wishes of the trust. Um, we also have a deed of appointment, so if trustees need to be changed or trustees added in, then you do have that. But yeah, once the loan trust deed is completed, like I say, with the settlers details, who the trustees are and who the beneficiaries are going to be, we then have our trustee application form. So the trustees would complete this, and this is the application form that would apply for the bond on behalf of the trust. Once that's complete, we do have a loan deed. We've got two LV. You've got English and Welsh law, as well as Scottish law as well. So that loan deed is just basically giving, it's just the settler agreeing to loan the asset, the investment bond, as an interest-free loan to the trust. So yeah, it's just the three forms, potentially four if you do need to use that deed of appointment later on down the line. But quite a straightforward process. And another thing that helps to make it straightforward, and this is something I always recommend to advisors when setting up loan trust, it's the dating of the forms. That can be quite key. You don't want the loan to be in place before the trust is set up, as an example. So what I tend to sort of say is keep the dates all at the same date. Even if you're going to pay by check, which is becoming less common, but it's something I tend to see, I'd also use the same date on the check. So our flexible loan trust deed, our trustee application form, and our loan agreement, as well as our check, all dated on the same date. Just keeps it nice and easy. There is also potential for other ID requirements for trustees, especially if they're overseas. We don't tend to see that as much, but we do get asked that question, and it is possible, but it does create complications, especially with the tax payable on the trust because of who the trustees are. But again, further advice you can get from us on that. And also on larger amounts of money, there might be some further money laundering requirements that are needed. But again, Neil and I are here to help you or help guide you, through what is needed at application stage. So, you're not having to go and chase it after the application's made, and then the team come back to you and say, "Can we have X, Y, Z?" So that's how to set up a loan trust. Once the trust is set up, it is a requirement to have it registered on the trustee registration service. So the trustees of the loan trust that you set up would need to go to the government gateway and then register the trust within 90 days. We'd also ask that we receive a certificate once it's set up to show that it has been set up by the trust registration service. When you get the slides, if you click on this image of the laptop, you can get a hyperlink through to our website where we have like an FAQ page on the trust registration service. It's really good. I've used it plenty of times when I was getting to know about how to do it, and questions about changing trustees and then updating it, all that type of stuff. So it's a really useful part of our website that can help you explain to your clients how to use this service. So that was going through the loan trust forms and how to set one up. I hope you agree that it's quite a straightforward process. As loan trusts have come back to the fore, plenty of advisors said to me, "Isn't it a complicated process?" Hopefully, I've made it easier for them, and I hope you agree that it is a more straightforward process. But I thought it would be important to talk through, the bond that is used. So within the LV loan trust, just to explain the features of that and why we think that it is suitable for a loan trust investment. Just going back to something that Lee mentioned at the start. So you've got a session coming up about risk profiles, and
we do indeed, yeah.
Yeah, is it all about risk profiles now, or could we be looking at the journey that the client goes on within their investment journey? So hopefully when I talk through our investment bond and how it works and the smoothing mechanism, etc., you'll sort of see that it isn't necessarily all about the risk profile, and the way that the smoothing and how the smoothing can fit into that, and alleviate certain risks for clients. So yeah, with the LV bond, it's an open-ended single premium onshore unitized with profit bonds. Can be owned by, as Neil mentioned in his part, can be owned by a trust, uh, lasting power of attorneys, as well as individuals and corporate investments. Minimum investment 5,000. There is a maximum of 1 million, but again, please speak to your BDM if you have got cases that are over 1 million. We just need to go through like a due diligence process on that to get it accepted. It's got 50 segments, so quite often what we see within trusts is that segments are assigned out to beneficiaries later on down the line. So that's a feature that you can use with the LV bond for a loan trust. The 5% deferred tax allowance, which can and any unused allowance can be rolled up into future years. Minimum age 17, maximum age of entry 89. It's got a death benefit on it as well, 100.1% death benefit, and suitable for regular and ad hoc withdrawals, which again, very important for a loan trust. On our cautious fund, we do have the option of a capital guarantee for those really, nervous clients or clients that want to make sure their capital is protected or underpinned. Then we do have a guarantee. On our cautious fund, it comes at a cost of 0.35%, and it's a 10-year spot guarantee. So if your 100,000 that you put in today isn't worth 100,000 in 10 years' time, the guarantee will kick in and bring it up to 100,000 less any withdrawals, basically. Just on costs on the right-hand side there. So with our bond, the AMC, it starts at 0.75%. And then it discounts back depending on how much you've got to invest. So for investments under 100,000, it starts at 0.75. 150 to 250,000, it starts to drop, and the maximum discount is at 250,000, which brings it all in at 0.6%. So there's no rapid charge to add on top of that. It's just the AMC. So that's the sort of quick facts of the bond and the charges. So let's have a look at the funds themselves, of which we've got 5 to choose from. LV are unique in that space that we've got 5 smoothed portfolios that you can potentially choose from. So they're all independently, we have had them, independently risk rated by several agencies, including Defaqto, Dynamic Planner, Oxford Risk, Synaptic, and eValue. The above risk, the risk ratings that we've got here are all out of 10. But I mentioned that we have a smoothed bond, so the risk ratings don't take into account the impact of the smoothing, and are just based on asset allocation alone. And our investment team will basically manage the asset mix to fit into these risk profiles. So they shouldn't drift into other risk profiles as they go on. We want 5 distinct risk profiles to cover, your range of customers. So if we just move on to who manages the investment. So LV retain complete control over the strategic asset allocation. That strategic asset allocation is looked at in great detail on a yearly basis, but depending on market events, the investment committee could bring that forward or look at it multiple times a year. LV sets the strategic asset allocation, typically looking at 5 years plus, and then the tactical decisions are made by BlackRock. So they do the tactical investing within set boundaries to enhance short-term gains. And we've seen plenty of examples with this. With our partnership with BlackRock last year is a great example of gold within the portfolio. So BlackRock made a tactical decision to go into gold at the start of the year, and I don't know if it was dumb luck or good judgment, but they sold it just at the right time before it started to decrease towards the end of last year as well. But BlackRock have really sort of shown the power of what they can bring to the table and the alpha that they bring to the portfolios as well. But it's an ongoing daily relationship that LV has. With BlackRock, and since they've become our investment partner, which is just over 3 years now, we've benefited extensively from the resources that they can bring to the table, and what has been a true partnership. So any more information on that, please do let us know. So we're going to now look at our smoothing mechanism and how that works. So this is what I'll attempt to describe to you now, but honestly, it is actually very easy. So what we've got on the left-hand axis is our unit price, and then across the bottom axis, we've got our time frame in months. The green line is the sort of unsmooth price or underlying price, and then the dark blue line at the start is our gradual average, and then the teal color is the smoothed price. So with LV, we have a smoothing mechanism that is based on the daily unit price over a period of 180 days, 6 months, 26 weeks. Yeah. So we take that daily unit price over that period and divide it by that number 180 to give us our smooth price today. And that smoothing continues on a daily rolling basis. So every day we look back 180 days, add all those prices up together, average them out to give us that smooth price. Before you get into that 6-month daily rolling average, we do have like a period of like buying into that smoothing, which is called our gradual average price. So if you're in it for 1 day, that's your and that'll be the underlying price, but also your smooth price because you've been in it for 1 day. Move on to 2 days, add those 2 days together, divide by that number. That gives you 2 days worth of smoothing, and that will continue to build 30 days, 60 days, 90 days until you get to that 6-month anniversary point or the 180th day, and then you move on to the 6-month daily rolling average. And what you can sort of see from this image is that it doesn't take long at all for that gradual average to start smoothing out your returns. So most of the examples I've seen, it's actually less than 2 weeks. So although you don't get that 6-month daily rolling average at the start, it's not like you're exposed or you're on the underlying price for that first 26 weeks. So ultimately, it's just an average of the daily unit prices. We feel this is a really nice, easy concept to relate to your clients, and again promotes like a nice, smoothed out journey, which takes all the ups and takes out the ups and downs of the underlying price or some of the sectors, which we'll look at some comparisons. Within the smoothing, we do have some protections that are built in. So in extreme circumstances, we do have the ability to suspend smoothing. Proudly to date, we've never had to do that. It is at our discretion. So yeah, it's a robust mechanism, and it's been around since 2009 now. So yeah, it's been tested basically, and we'll have a look at some of those tests within the next few examples. So just on the smoothing and what effect that does have. So I'll just quickly take you through the FE fund risk scores. What that does is it plots a fund's risk. It plots a fund's volatility score relative to the FTSE 100. Yeah, get my teeth in as well, Lee. So you can see the FTSE 100 is always scored at 100. And then some funds can be over that as well. But if I just look at the mixed ABI sector 40 to 85% shares, you can sort of see you're getting 58% of the volatility of the FTSE 100. If we look at LV's Smooth Managed Growth Fund, which is fifth from the bottom, which sits in that 40 to 85% shares, that's what we would use to compare against. You can sort of see that it's a 9. So it's got the same asset mix of funds within that 40 to 85% shares, but far less volatility, and that's what we aim to do with the Smooth Fund, and why we feel it's suitable for decumulation when you're taking income, and possibly with bonds and loan trusts again, where income or ad hoc withdrawals are key to the client. So next slide, like I say, we've been a smooth fund provider since 2005. With the current version of the funds, like I say, since 2009. What I wanted to do here was just show you some long-term performance. So we've got the volatility index running across the bottom, that light blue color, and then we've got the 40 to 85% sector. And then we've got our managed growth fund, which is a DT risk profile 5 and sits within that sector. And as you can see, it's smoothed out all the ups and downs of all those key market events through that period. If we're just going to zoom into a few of those now, just look at it in a bit of detail. So COVID, where we watched well, I probably don't need to introduce, what COVID was and what happened, but to sum it up, the 40 to 85% sector there dropped 17.5%. The largest daily drop within our growth fund was just 0.1% through that period. So you can sort of see the protection that the smoothing affords. And as the sectors came back, our smoothing starts to pull in an upwards trajectory again thereafter. If we look at the Ukraine crisis, this was more of a prolonged period of downward performance. And because we are smoothing in an average, you can see the average can't defy gravity, so it starts to follow in that direction with more prolonged periods of market losses. But it is protecting clients from the bottom of what the sectors are reaching. If we have a look at more sort of like modern, or sorry, not more modern, of what we've experienced recently with the Iran conflict, because of all of the good pricing from the back end of what was a great year last year and early into this year. All that average built into our smoothing, and actually our smooth price increased every day during the Iran conflict. So that's having a look at those individual bits. We're sort of getting towards the end of my bit now, Lee, which I think takes us on to a poll.
It does indeed. It does indeed. And I just want to call out, we're 4 minutes out. So I'll just launch this poll quickly because I want to make sure everybody gets time to get through the content. It's guess the largest daily drop, right? It's you got a couple of options here. So without going on too much, I'll just let people get a vote in so we can. I just want to make sure we get all of your content done.
We are pretty much at the. We are pretty much.
This is it. We're pretty much there.
Yeah. But yeah. So sorry. Yeah, I've rabbled on a bit too much. I get excited about the fund, you see. So yeah.
That's absolutely fine. I've got loads of questions to probe about you, but I'm just going to sit on them, which is absolutely fine. This is going to be interesting, isn't it? I like, I guess, the largest daily drop. It'll get people thinking about the risk of perception and client behavior as well. So that's quite nice. We've got loads of people still voting, which is very good. And look, appreciate guys and girls, if you got to shoot off in 3 minutes at 11 o'clock, that's fine. We might just overrun by a couple of minutes, so please do hang around if you can. Not a problem if you got to get off. I'll just end the poll there and share the results for everybody to see. Are you surprised by that outcome, Vinny? Is that what you expected people to where you'd expect people to cast their vote?
Yeah, I mean it's a tough one because if you're not used to the fund and how it works, yeah, but it's pleasing to sort of see because everyone can sort of see here that the smoothing does take the volatility out of the investment. I mean, well, I don't know how this is going to work, but the actual result is just 0.3%. So it just sort of shows the power of what the smoothing does. And like I say, if anyone wants to explore the smooth funds in more detail with Neil and myself or your contact, we can sort of show you that even though we do have that smoothing within it, it doesn't harm you on performance too much, and it's always building into the fund the performance. So it's not like it's held back to save it for poorer times. It just gets smoothed in as we go. So I think. Denise, can you bring up the? There we go. So we've got the largest daily drop within that. We've just put it into some monetary terms as well, just on what 100 grand would mean with that. So that would have just been a £200 max loss within the fund. So again, clients who are particularly nervous about investing or ultra cautious, hopefully that shouldn't give them too much of a fear about having their money invested. But there's just a couple more slides, Denise, that we wanted to talk about. So just from investing within this fund with LV, you do become entitled to our mutual bonus. So we are a mutual, and our members can expect like a profit share each year is the best way to describe it. Since 2011, over 347 million paid out to our members. So as long as you've been invested for 12 months or longer, you become eligible, and you get that as an extra benefit. It's almost like extra growth to your fund. If you're getting 0.15% added. Again, looking at the cost, 0.6%. If you get 0.15% added each year, it goes a long way in sort of paying for some of those costs. And then just on our member benefits as well. So I won't go through these in great detail because we're at the end. But yeah, these are all available to your clients who invest within the LV bond within our Smooth funds. Again, please do let us know if you want to have a chat about these, because these are really fantastic, and I'm sorry I haven't given enough time to do them justice. But these are available all free of charge to your clients who invest within the fund. I think that brings us to the end, to a Q&A potentially.
Yeah, definitely. I know we've got a hand that's been raised, and sometimes when I call out the person that's raised their hand, sometimes I panic and realize I didn't actually mean to raise their hand, and they lower it instantly. But Rebecca, the hand is raised. If you've got a question, then please do let us know. Or if it is a slip of the finger, which tends to happen, and now you're probably panicking, thinking, "How do I put my hand down? I don't want to raise my hand." That's absolutely fine, guys. Really enjoyed that. Really good session, really insightful. The whole process, the benefits, and how to set everything up is really insightful. Hopefully, the audience found it just as insightful. And again, when you exit today's webinar, you will be asked to participate, give us some feedback. We think it's incredibly important. That's where we can reach out and you can speak to the guys at LV. You can be involved with our communities, whatever you need off the back of everything you can do. So we've had a question come in. I have a question. Client with 500K to invest, but would like to take income from a bond, DGT, or loan trust. Let me have a look at that. So guys, you can see this in the Q&A as well. So client with 500K to invest, but would like to take income from a bond, DGT, or loan trust. I think they're saying what would be the most suitable suggestion, maybe?
Yeah, I mean, going back to some of the points about the chargeable lifetime transfer. So on that 500,000, if that's a single settler, there will be a CLT charge to pay on over the nil rate band over the 325. So there could be a potential option there to blend the two. The loan trust isn't a chargeable lifetime transfer, so you might want to start with that, then do a part with with the DGT. Would you agree, Neil? Other options about do they want flexibility over their income, or are they happy with the set amount that the DGT offers? Are they happy with the discount that the DGT offers potentially? But those are some of the thoughts that are flying through my mind at the moment, Neil. I don't know about yourself.
The process for the loan trust is much simpler and much more straightforward. The DGT, because of the discount that gets applied to the initial gift on day one, has become slightly more complicated than when we started doing them 25, 30 years ago. And now most providers require a doctor's report. So that delays the time and the start off, and any discount that applies on the DGT is dependent on the client's health and life expectancy. But from the allowance point of view, Vin is right. So it's looking at there's no right or wrong. It's looking at what the client's circumstances are and looking at potentially what outcome they're looking for. If they don't need access to the income, well, then looking at some form of immediate gift might be more appropriate because they only have to survive 7 years. And even not use a trust, but if they're looking for access and looking for control, then a loan trust is an appropriate way to look. But it's down to individual clients.
Yeah, absolutely. Thanks for answering that question. If there's any other questions, then please do feel free to take this time to speak with either Neil or Vinny and the LV team. But for the purpose, I just want to thank you all for coming along to another webinar. Thank you for joining LV and the Financial Planning Club today on a Wednesday morning, which is a little bit out of the norm because it's normally a Friday morning. I've just got to remember I do have to come back to work for the next 2 days, and it's not the weekend. Thank you all. I'm going to stop the recording for the purpose of today's session.